In this episode of the Dana Yee Show, I'm going to explain why increasing my dividend income is not the main focus of my portfolio. Firstly, I want to make it very clear that I'm not bagging on dividend investing by any means. I completely understand its merits and why some people choose to focus solely on this method. I just personally focus most of my investing in a different way. Just sort of to prove my point, here's a screenshot that I pulled from my broker. My 2021 estimated dividend income is about $834.58, which comes out to a monthly average of just around $70. So if I don't do anything to my portfolio and leave it the way it is, I can expect to earn around this much just sort of from the companies that I have, which is really nice. And my point of showing this is that I'm not actively avoiding dividends, I just focus most of my investing in a different way. And if you want to see my entire portfolio, make sure to bop that like button and hit subscribe, as I plan to show a lot more of it on this channel in the future. I was thinking about this for a really long time, and I came up with a bunch of reasons, but all of those reasons sort of come back to the fact that I'm a young investor. I have a lot of time. I can stomach the ups and downs of the market because my investing timeline is not for the end of this year or the end of next year. It's for at least 10, 20, 30 plus years from now. Also, one kind of side note is that when I start working full-time, I'll be working in tech, and I've always been fascinated by technology and innovation. So a lot of my companies are technology focused or future focused, and those types of companies tend to be younger and not pay dividends, but I see a lot more growth in them. Okay, speaking of growth, I guess my main way of investing, you could classify it as growth. I do employ different types of investing, but a lot of my companies I choose because I see them growing a lot in the future. Sort of conversely, if we look at the dividend aristocrats list, so these are the companies in the S&P 500 that have paid and increased their dividends over the past 25 years. If we take a look at some of these companies, 3M, Coca-Cola, Johnson & Johnson, which I actually do own some of, Procter & Gamble, etc. These aren't bad companies by any means. These are just very large, very well-established companies, and I don't see a problem per se with these companies, but I think they will have a harder time growing and evolving in this technological era. Again, I'm not saying these companies are bad by any means, I just think it's going to be harder for them to grow. Sort of conversely with that, a lot of growth companies, they don't pay dividends. So going back to my favorite example, Tesla, if we look at their dividend yield, it is a dash, which just means they don't pay dividends. And the way it ends up is that a lot of these growth companies that I like, they don't pay dividends because they're in the growing phases, so it's not as smart for them to pay out part of their profits to investors. So one sort of silly and purely hypothetical example that I came up with was kind of showing the difference between a growth and a more dividend-focused company. So let's do dividend versus growth company. These are all hypotheticals, nothing is certain in the market, so again, just playing with some numbers here. If we take some random growth company, let's call it company A, and their stock is currently trading for $100, and they have a 10% yield annually. What does this mean? This means that for every $100 you invest, you'll earn about $10 a year in dividends. If we don't calculate the compound interest in, because I didn't have the foresight to do this on a calculator, after 10 years, this $100 will turn into $200 if the stock price doesn't change at all, right? Because every year they'll be paying you $10. So it's actually going to be more than $200 because of the way compounding works. So I don't know, it might be more like $250. We'll just leave it at $250. If we contrast this to some other company B, let's say it's also trading at $100 and they pay a 0% yield, which is to say, if the stock price doesn't change and you have $100 invested, it's going to be worth, well, $100 at the end of the year. However, B is a growth company. So let's say after 10 years, they 5x in size. So the stock itself goes from $100 to $500. With some quick maths, that's a 5 times return. So even with the compound dividends in case A, this growth company will have higher returns than the dividend company. Again, I'm making a lot of assumptions here that you really can't make in the market. I'm making the assumption that the price of A doesn't change over time, the dividend of A doesn't change over time, and the fact that B 5 times in price. I guess the point of this example is just to show that even with companies that have really high dividends, a company that grows significantly will outpace those dividends over time. One more thing I always like to talk about, dividends are not the only way to make income in the stock market. You can also sell options to make income. So for example, I have 100 shares of MP and I sold sold this covered call for $150, and MP is a growth company, so I'm happy holding this company. And by selling calls against it, I'm able to sort of bring in income instead of investing in dividend companies and having them pay me income. One more thing I sort of wanted to briefly mention is that part of the reason why a lot of these large tech companies or large growth companies don't have a dividend yield, for example, Amazon here, their dividend yield is also a dash, which means they don't pay dividends, is that they heavily reinvest into themselves. And for growth companies, I generally think that investing into themselves to grow more in the future is better than if they paid, I don't know, like 2 or 3% to the investor. What they could do with that 2 to 3% is probably significantly more than whatever I could do with that 2 to 3%. Kind of bouncing off of that point, when you get paid dividends, and I believe at the end of the year, this is in a 1099 DIV form. That's a D, not an O. Just ignore my handwriting. Maybe I should fix this. DIV. Unless it's in a tax advantage account, you're going to have to pay taxes on that dividend income, and that tax rate is anywhere between 0 to 20%. So in that view, it might be better to just have the company grow a lot over time, and if they're not paying dividends, you don't have to pay taxes on those dividends, obviously, because you're not getting paid them, versus a company that's paying dividends and you have to pay taxes on those dividends. The last reason that I came up with as to why I'm not so focused on growing the dividend income in my portfolio is that I'm not relying on gains or income from my portfolio to survive or pay bills or cover any living expenses. So I'm completely comfortable if my portfolio drops 2 to 3% in a day. I mean, it's done 5 to 6 and I'm just like, all right, thanks. I have other sources of income that are much more substantial, and I would like in the future to be able to use my income for my portfolio to supplement my lifestyle, but as of currently, I don't need it to survive. So I feel much less stress and I feel much better taking more risk in the long term to see potentially a lot more growth. Sort of circling back to everything, the main reason that I came up with is that I am young, and this means that I have time in the market, and personally I'm willing to take the risk and potentially wait a long time for those higher returns because I don't need the income from this portfolio to support myself. So let me know down below what type of investor you are or what type of investing you're looking into. And again, I just want to reiterate that I'm not saying dividend investing is bad by any means. In fact, I have a few stocks that I got because I think their dividends are going to grow over time, but each person is different. They have a different investing timeline. They have different risk tolerances, different financial situations. So there's no one size fits all way of investing. Anyway, I hope you enjoyed my little ramble. Let me know what you guys think, and I'll see you guys next time.